Hello, Daryl.
Hey, Bruno.
Hello, Martina. Salut, Pierre-Olivier. Merci d'être là.
Okay, let's get started.
Évidemment.
All right, welcome everyone to our SaMMF virtual seminar. We're really happy to have Bruno Biais today presenting incentive constrained risk sharing, segmentation, and asset pricing. His co-authors are also joining us, Johan Hombert and Pierre-Olivier Weill. They'll be in attendance. We also have an excellent group of panelists that are joining us today, whose names you could see there on the slides. Thank you all very much for joining. Just a quick reminder of the format of our seminars. The talk's going to be 60 minutes long. At the very end of the talk, there's a 15-minute open Q&A discussion. You'll notice during the talk, our panelists are able to freely unmute themselves to ask questions. If you're in the audience, we invite you to also ask questions during the talk. You can do so using the written Q&A feature on Zoom, and then Johan and Pierre-Olivier Weill are also going to be able to answer those questions during through the Q&A during the talk. And then at the very end, we're going to open up the floor to everyone in the open Q&A. And if you're in the audience, you can use the raised hand feature on Zoom. Okay, finally, before we start, I wanted to point out our next seminar is in 2 weeks from today. Shuyang Shi is going to join us. And then our next workshop is actually this week, Wednesday through Friday, the Madison Money Meeting. And if you're interested in that, you can find all the details and how to register to get links to join on our website. Okay, without further ado, Bruno, let me stop my share. You can start sharing your slides and start whenever you want.
Okay, let me try. Okay, does it work?
It looks great.
Fantastic. Thank you so much. It's really nice to see you all. Really, these things matter a lot now. And also, I must say that Zach, on top of being an excellent economist, is one of the best persons in the world in terms of pronouncing my name. Biais, you know, it's usually people say bias, which is a little bit less nice. But Zach, thank you very much for the beautiful pronunciation. So it's really nice to be with you guys. Thanks a lot for taking the time. I know you are bombarded with Zoom seminars, so I'm thankful. So this is joint work with Johan and Pierre-Olivier, and I'm very happy that they are here. Thanks a lot. And so this paper is about one of the main functions of financial markets, which is to facilitate risk sharing. And so the kind of situation we have in mind is one in which you have a guy who's more risk tolerant and a guy who's more risk averse. And the guy who's more tolerant will sell insurance to the guys who's more risk averse in the form of trades in derivative securities and contracts. And so we study this kind of interaction in a dynamic environment and in equilibrium environment. It's only an exchange economy, so there's no production. And so the main ingredient, so basically what we do is we take a 101 financial market model, and the one ingredient, one imperfection that we introduce is borrowed from corporate finance. And it's the idea that there is a cost when there is a bankruptcy. Some money is lost, some money is stolen or left. And so now I suppose I sold you a put, and when the time comes for you to exercise the put or the CDS or whatever, I'm bankrupt. Now what you can do is you can come and grab my assets, but that can be very costly. It may happen that what you're able to get is lower than the value of my assets. Because of all the costs and complications and delays associated with the bankruptcy process. And so this is the one ingredient that we have in the model. People can, if you want, strategically default, in which case the creditors grabbing the asset will lose a fraction of their value. So that will translate into an incentive compatibility constraint. And that incentive compatibility constraint will reflect the fact that the debtors could be tempted to take advantage of the cost of default to renegotiate down their claims. So suppose I'm Mr. I, and I sold you some arrow securities that pay in state S. And now state S comes, and you say, Bruno, you have to pay. And I say, no, I'm bankrupt. Then you can grab my assets. But we assume that you will get only a fraction 1 minus theta of my assets. So a fraction theta will be lost for you. So realizing this, I can tell you, look, I know I have a debt, but let's renegotiate the debt, and I will pay you, for example, 1 minus theta times the value of my trees, my assets. And this is as much as you would get if you were to go for bankruptcy and grab my assets. So if it's a take it or leave it offer, you will accept that offer. But anticipating that ex ante, you realize that you don't want to buy any promise that would promise to pay more than 1 minus theta, the value of my trees. So this is the highest possible amount I can promise to pay.
Bruno, can I ask a quick question?
Yes, thank you, Ben. Nice to see you.
Good to see you too. But so it's kind of I think about your assets as your assets now, right? I couldn't possibly kind of come after some future. I'm thinking about the people who tend to issue these things. That they also sometimes have sort of value in terms of profits they can generate in the future as well. So this is going to be, I can grab a certain amount of what you hold at time t.
So yes, I'm. Let's say I agree almost 100%. Let's just me try to add a little something. So at time t, we write the contract. So at time t, I tell you, if let's say at time t plus 1, state S occurs, then I will pay you something. And it is at time t plus 1 that then I could default and you could grab my assets. So at time t, we are writing the contract and we are anticipating that I cannot credibly promise you more at t plus 1 than a certain fraction of the value of my assets at t plus 1.
Got it. Thanks.
It's very funny because you have some lines on the face, you look a bit like a zebra or something. No, it's nice, I like it. You should keep it. So,
Bruno, can I
yes.
also ask a question? Is
Sure,
it important that fraction theta is lost, or is it just important that the lender can only grab 1 minus theta?
Hi, Adriano, I haven't seen you. It's very nice to see you. So, yes, thank you very much. That's an important question. In fact, it does not matter. In the way we have framed the model, it does not matter. There would be almost equivalent ways in which it would matter, but in our framework, so basically I promise to pay you some amount, and then we assume at the time, I promise to pay you at t plus 1, and we assume that at t plus 1, I go to see you and I say, Adriano, I make you a take it or leave it offer. This is the amount I propose to pay to you. And if you don't accept my offer, you're gonna grab my assets and get 1 minus theta times the value of my trees. So, and of course, I will structure the offer so that you're happy to accept it. And so therefore on the equilibrium path, there will be no default on the equilibrium path. And so what would have happened if you had rejected my offer? Well, maybe I could have absconded with a fraction theta of the assets, or maybe I could not have done that, but it doesn't really matter in this formulation.
Okay, got it.
Thank you very much. It's an important question, thanks. Okay, so basically we have a limited commitment. We cannot credibly promise more than 1 minus theta of the trees. And if you want this 1 minus theta of the trees to use the Holmstrom and Tirol formulation, that's the pledgeable part of the trees, and that's lower than the total part of the trees. And the fact that I have limited ability to promise to pay, that implies that the guy who was risk tolerant and said, okay, I'm going to sell you some insurance. Well, he won't be able to do that fully because there will be the limit to how much he can promise to pay. And so that will generate incompleteness in the market, endogenously generate market incompleteness. And so what we do is we take this and we study the consequences of that for risk sharing, portfolio choice, and pricing. Okay, so just I will try to tell you very briefly what are the main results before I show you the model, if you allow me. So let's think about the frictionless case. Well, in the frictionless case, in equilibrium, we share risk perfectly. And when we do that, our intertemporal marginal rates of substitutions are equalized. And so this means that we have the same valuation operator or pricing kernel. We all agree on the pricing. Now, in our framework, we cannot do that. The market there are frictions in the market. We have incentive constraints. And those incentive constraints will prevent us from fully sharing risk. And because of that, we will have in equilibrium different intertemporal marginal rates of substitution, which means that when we think about it in terms of pricing, that we will have different valuation operators. And so there will be a group of people who have the same valuation operator, and each group of people with a given valuation operator will hold a portfolio of assets that correspond to this valuation operator. And these different groups will be non-overlapping. So that will be a form of segmentation, very strong form of segmentation. So for example, if I am a guy who has a bad exposure to the bad state of the world, my own labor income is very, very low in the bad state of the world. What I want to do is I want to buy assets that pay in those states. While the guys who are not exposed to that risk, they will be willing to sell me those assets. So this is, to some extent, in line with the empirical evidence by Sylvain Catherine and his co-authors, who find empirically that workers facing high left tail income risk when equity markets perform poorly are less likely to participate in the stock market. Okay, so now let's do a bit of intellectual history. So what we do is really very much in line with what was done by Alvarez and German. And they showed that the guys who are the price setter for the arrow prices, for the arrow securities, are the guys who are not constrained in the state corresponding to that arrow security. Because of course, because they are not constrained in that state, if the price of that state was different from their intertemporal marginal rate of substitution, they would trade. So they must be equal in equilibrium. In contrast, if I am constrained in state S, then in fact, it won't be the case in equilibrium that my marginal rate of substitution will be equal to the price of state S. And in fact, in equilibrium, it's going to be lower. My price, my own pricing operator will be lower than the market arrow security price. So when I see that my valuation is lower than the market price, I would like to sell. But that's the point. I'm constrained. My constraint binds. And what does that mean? It means I cannot sell. Because selling an arrow security, if you want, is borrowing in a state contingent manner. And my constraint binds when my borrowing constraint relative to that state prevents me from borrowing. Okay, so that's in a sense, that's not us. Huh? That's coming from the literature.
So Bruno, may I ask you a question on
Sure.
the intellectual history that you mentioned? So Allen and Gale, 1988, optimal security design.
Yes.
They have a lot of what you're talking about. So how is what you're doing different?
Oh, it's terrible. I don't remember.
Okay, so never mind. Then move on. We can discuss later.
I must absolutely make a note of it because I have the deepest respect to both of them, and I should know their paper. I'm sorry. I apologize for that.
So Allen and Gale is static. I should mention that 1988, but it's now been put in dynamic frameworks also, and it has exactly some of the flavor that you were talking about. So, but anyway, let's do that later.
Yes. Thank you very much, Johan. I will definitely look at that paper.
Pleasure.
And be more precise. So now an implication of this thing about my marginal rate of substitution being lower than the arrow price is the following. So let's consider the situation in which for each of the agents in economy, there is at least one state in which their IC binds. So for that state, their own private valuation operator is lower than the market arrow price. Now, what's the price of an asset, a tree? A tree is a stream of dividends. What's the price of a tree in that economy? It is the maximum across all the agents in the economy of their private valuation for that tree. But now, if every agent has at least one state in which this agent is constrained, then every private valuation for the tree will be lower than the valuation of the tree using the arrow security price. Which means that the price of the tree will be lower than the value of the replicating portfolio of arrow securities. And that is, there will be a basis. And when you see a basis, you see the price, the tree is cheap relative to the replicating portfolio, you say, haha, I can arbitrage that. Well, to arbitrage that, you have to sell the expensive part. And what is expensive? It's the arrow securities. But that's what you cannot do because you're constrained. All right, so we think an example of that situation is the case of, because basically what we have is we have a portfolio, we have a basis between a tree and a portfolio of arrow securities, or if you want, also equivalently between a tree and any portfolio of long positions in other trees and arrow securities. So now let's consider a convert. Yes, Marzena.
So in the model, agents are allowed to trade trees. What if you allow them to trade arrow security instead? Or what if you unbundle the trees somehow towards?
Okay, thank you very much, Marzena. Those are very, very important questions. And they're different and they have different answers. So first answer, the easy answer. We allow, the market is complete in the sense that a priori people can do what they want. They can trade trees, they can trade all the arrow securities they want. And there will be, in fact, limitations to their ability to trade arrow securities, but those will be endogenous.
Okay.
So there is a market for each arrow security. I can go to the market and trade, but some of my trades will not be incentive compatible and people will not accept to do the trade with me. Okay, so that's the answer to the first question. The second question you asked was, could you unbundle the trees? And so in a sense, there are two ways to think about that. One way to unbundle a tree is to say, let me issue arrow securities that are backed by the tree. Mm-hmm. And that's something we show is going to be limited by incentive compatibility constraint. So people would like to do that, but they will be able to do it only to a limited extent. Now, there would be another way to unbundle the tree that would be like physical, I would physically cut the tree in parts. And so with this, we assume it's not possible. So, you have a tree and tomorrow the weather can be good or can be bad. If the weather is good, there will be apples. If the weather is bad, there will be no apples. We assume that it's not possible to cut the tree in half and then have one half that corresponds to good weather physically and the other half that corresponds to bad weather. So that's the sense in which we assume unbundling is not possible.
Thank you. Thank you very much.
Thank you very much, Marzena. That was an important point. Okay, so a convertible bond can be thought of as a portfolio of a long position in a straight bond and a long position in a call. And our theory says, well, therefore, the convertible bond should be priced lower than the replicating portfolio of long positions in straight bonds and call. And this is something that I think is observed in practice. And both in our model and in practice, people will try to arbitrage that. And to arbitrage that, they will try to sell the expensive leg of the arbitrage. And both in our model and in practice, their ability to do so will be constrained. There's a point at which hedge funds will be no longer allowed to take very, very, very short positions.
Bruno, just to understand, yes. in this analogy, you're interpreting the convertible bond as a tree, because if it is in itself a portfolio of state contingent claims, then there would be an equivalence, would there not?
You're absolutely right. You're absolutely right, Adriano. I understand how the mapping between our theory and the real world is not 100% satisfactory. I think the way I think about it is a convertible bond is a tree, a straight bond is a tree, and a call is a narrow security or a portfolio of narrow security. That's the way I think.
Bruno, I have a follow-up question. So if these trees are corporate securities and they are priced below the replicating portfolio, why would a firm issue such trees? In other words, put differently, the trees in your model are contracts, and these contracts should be optimal. Yes. So I think this is a relevant question when trees are financial securities rather than, for example, land.
Yes. So you're right, Georgia. I mean, and your question and Adriano's question are really right on the mark. I think it's a limitation of what we do. In a sense, we take the trees as exogenous. And then what we call contracts are the arrow securities, which people can optimally decide how to issue. So I think there are two ways to take on board Adriano's point and your point. One way is to think of the trees as contracts themselves, which should be endogenized. The other is to think of the trees as real assets, real production technologies. And so that second way, in a way, eliminates corporate finance from the picture. It's just an economy in which you have productive resources and you have ownership of those productive resources, and you trade claims that are contingent on the output of those resources.
Then you
that's the way we think about it right now. But clearly, both the production side and the corporate finance side, I agree with you, that should be done. It's not done in this paper, but yes.
But then if I go with the second interpretation, can you say much about asset prices?
I think we can. Well, it's a models are metaphor, and so we are pricing the real assets in the economy. That's, I think, the way I think about it.
Thank you.
Thank you. So, salut Pierre, je te vois en face de moi. So the last empirical prediction from the paper is it's almost the same thing as what we just said about basis. It's something about pricing, factor pricing. So let's assume that we have a certain number of factors in this economy, and let's project the returns of the assets onto those factors. Let's run a regression on those factors. Now, if the residuals from that regression are orthogonal to the agent's private valuations, then we have the result that in equilibrium, the expected returns on the assets are going to be concave in factor loading. So let's take, to illustrate that, let's take the example of one factor. It's an economy with only one factor. And let's consider three trees. And we have tree one, which is, it is in the middle between tree two and tree three. Because its beta is an average of the betas of tree two and tree three. Well, it is that means the price of that tree is going to be lower than the price of the replicating portfolio of the two other trees. And therefore, the expected return, holding dividend constant, will be higher for that tree than for than the average of the expected returns of the two other trees, i.e., expected returns are concave in factor loadings. So that's, I think that's consistent with some empirical results. Initially black and then next other papers after black, I think got that result. All right, so literature now. So as I told you, we're in the line of Kehoe and Levine and Alvarez and German, and also to some extent the work of the monetary new monetary approach, because of the limited commitment assumption. So an important difference between what we do, between what we assume and what they assume, is that in that literature so far, what was imperfectly pledgeable was the income, if you want, the fruits from the trees. What we assume is that the trees themselves are imperfectly pledgeable. And so that makes our paper, oh, there's a paper I should have mentioned that, I'm sorry about that. There's a paper by Lustig that also is an important paper in that literature. So now, this friction that we introduced, that the assets, not the income, are imperfectly pledgeable, that is actually something that has been studied in the literature, in the corporate finance literature. And so, for example, our paper is directly in line with the paper by Adriano and Vish, and that paper studies imperfectly pledgeable assets. And so, because in their paper, because the assets are imperfectly pledgeable, that translates into limited commitment, and that endogenizes financial contracts and borrowing constraints. So in a sense, our paper, which also has those borrowing constraints, is like directly in the line of the paper of Vish and Adriano. In a sense, our paper, you could think of it as Rampini-Vish meets Kehoe, Levine, etc. So the
Bruno,
difference, yes?
Yeah, so maybe it's not the right time, but we do have a paper called Financing Insurance. It's a working paper for many years, where we don't focus on asset markets. We have assets and labor shocks, and we endogenize the interest rate, which is like the price there. And what we show is, if there's sufficient collateral, you get complete markets. If it's insufficient collateral, the interest rate is very low. Of course, we're doing a law of large numbers, so we don't have aggregate shocks. The big difference here is you seem to have aggregate shocks.
Yes.
If I'm correct.
Yes.
So we go some distance, not quite what you're doing, but we do have endogenous interest rates, and we look at this Arrow-Debreu perfect versus imperfect risk share.
Okay. Well, Vish, thanks a lot. That's very very useful to know. So okay, that's another paper I must read. Alan and Gail, and the insurance paper by Adriano and Vish. Yeah. So I haven't read your paper yet, so I cannot say anything serious. But yes, the pricing of aggregate risk is an important element in our analysis. So that's a bit different, apparently, from what you guys are doing. But I definitely will look more seriously into your paper. I will look seriously in your paper and try to be more precise on the difference. Thank you very much. Another difference is that in the Rampini and Vish paper that I could mention here, you guys have production, which is of course very important when you think about the corporate finance side of things. And it's related to the discussion we had before with Georgia. So we don't have production, we only have an exchange economy. So that's of course a difference. Okay, so another line of literature with which we are related is the line of literature looking at incomplete markets. Of course, we're definitely directly related to what they have. So I think that in a sense, the selling point in what we do is that we try to go a bit deeper into endogenizing incompleteness, and the way in which the incompleteness is endogenized determines the nature of the implications from the model. And also relative to the interesting paper by Galano and Peterson, what we do, we try to dig a bit deeper into the foundations. In particular, they have exogenous margin constraints, while we have, through the limited commitment thing, we have endogenous limitations. And what they have is that they have, their assets are assumed to have exogenously different margin constraints, while in our approach, all the assets are identically imperfectly pledgeable. They all have the same theta. But in the end, they will endogenously have different bases, and that will be driven by the structure of their payouts, their dividends. Okay, so I'm now going to plunge in the model, except if you want to ask questions. So exchange economy, T periods, states S, trees are claims on streams of dividend that depend on the states. There's a supply N of trees, and we have agents, I, capital I, types of agents, each in measure 1, competitive, and they have an endowment. Initially, they have an endowment of the market portfolio, and also along the way, they're going to have labor income. And so they maximize their intertemporal utility, discount factor, probability, utility, consumption. Okay. So this is 101 asset pricing equilibrium. Also 101 asset pricing equilibrium.
That's the question. I'm a panelist. This is Randy. This is Randy. Can you hear me?
Yes, Randy. Nice to hear you. Where are you?
I'm in Madison.
Okay.
I guess this is Finance 101, but why don't you go, to Finance 102 and consider an infinite horizon? What is this T period model?
Yeah, you're right. It's actually it's actually hard to go to 102. We think the results will be the same, but we have not been able to characterize things in infinite horizon.
I mean, we'd expect to be a much bigger set of equilibria in the infinite horizon model.
Yes, that's definitely
outcomes and non-stationary fluctuations, etc. So it'd be worth pursuing that case as well.
You're absolutely right, Randy. This is true. I must say, however, that we have not been able to prove uniqueness even with finite horizon. I'm not saying there are multiple equilibriums. I'm just saying I don't know. It's a bit complicated, but you're right. That would be certainly an important thing to do and might qualitatively change some of the results. So budget constraints, my consumption, plus the value of the trees I buy, plus the value of the arrow securities I buy, has to be lower than my resources, which is my labor income, plus the fruits and the capital gains from the trees I bought last period, plus the payoff from the arrow securities I traded last period. This A, which is the number of arrow security of state S, which I trade, this can be a positive number, in which case I take a long position in the arrow security, or a negative number, in which case I'm taking a short position in the arrow security, I'm selling. And in a sense, that's a form of debt. When I sell the arrow security, it's a state contingent debt. Okay. So that's,
Bruno?
Yes.
Why do you need the endowment also? Wouldn't it be possible to just have a tree-only economy?
You're absolutely right, Adriano. You're completely right. We don't need that. We don't need the endowment. But the reason why we added the endowment is the literature, Kehoe Levin, Alvarez German, Chen Lustig, they have endowments. And we wanted to be in line with them. But qualitative results do not depend on this assumption. You're perfectly right. So now comes the big important constraint. It says that, so remember, when A is negative, it means I've sold the arrow security. So this is the absolute value of my state contingent debt. And so that constraint says it's, if you want, a borrowing constraint on state contingent debt. It says my state contingent debt cannot be larger than what? Than, well, this is the price of my trees plus their dividends plus the quantity of tree I hold. So that's the value of my trees. So how much debt can I get? Can I take? Well, I cannot borrow fully to the value of my trees. I can only borrow a fraction 1 minus theta of the value of my trees. So that part, if you want, is the pledgeable part of my trees. Okay, and that's going to be the constraint that will prevent first best. And you see, compared to the literature, sometimes some people in the literature, they're looking at asset by asset constraint. We are not. We are putting all the assets together. And so it's in line with the practice of portfolio margining. So we have a constraint for the whole portfolio, but it's a state-by-state constraint. There is one constraint for each state.
So Bruno, yes. So that means when you have one period to go, there is no price, there's only a dividend?
Exactly.
And yes. That's something that you want to exploit in some way?
It helps.
Otherwise the price would be in your, that's the problem with the infinite horizon in some sense.
Yeah, you're perfectly right. That's absolutely true. Yes, absolutely. So that's exactly like what Vij was saying. I mean, I'm going to say something less deep than what he was saying, but if you want to think about this as a one-period model, you just get rid of this price, and that's it. And that's what we had in the previous version of the paper. And now we have the dynamics.
You're also assuming that the assets and dividends are equally pledgeable, are both pledgeable. That's probably also not of the essence.
So yeah, that's right. We're assuming that it's the same theta for everything. Because we thought it was simpler. It could be different. It would not fundamentally change the qualitative effects, but it would make things more complicated. But you're right, Adriano. This is an assumption we are making. Yes, and it may be in reality it's not like that.
Bruno, can I ask a question?
Yes.
So here you're allowing only contracting on the state. So for example, you cannot contract on other people's contracts. So I'm thinking about covenants or negative pledge covenants. Have you thought at all if this matters and how?
Okay, so that's an interesting question. On the equilibrium path, everything depends on the state. So when we look at things that are on equilibrium path, writing contracts on states, contingent on states, is the same as writing contracts on anything else. But that may not be the end of the story. Maybe I need to think more about that.
I was thinking about punishments of path, but maybe you can talk about it later.
So, okay, that's an important assumption. Very important. I should have said that. Oh, I'm sorry. So what we are doing here, Georgia, is what you say is very important. Thank you very much. We are basically choosing the simplest possible way to model this, which is the way of Chen and Lustig. We are assuming that when people default, they can come back to the market at the next period with a mask, and nobody can recognize them. So I don't like this assumption, but it simplifies the analysis a lot.
I think that does it. Thank you.
Yeah, thank you. No. Thank you very much, Alice.
A quick question. So it's related to an earlier question by Giano. What if you can also pledge your endowment?
Yes. Thank you very much, Bachimek. This is a really important point. So we are assuming that endowments are fully non-pledgeable. And you're right, it's related to the question that Adriano asked before. we could have assumed that there was a theta for the endowments also. And again, that would have given different formulas, but the spirit of the result would not be changed. You know, because as we discussed with Adriano before, if we didn't have the endowments, frankly, that labor endowment, that wouldn't change much in the important result. But thank you very much. That's a good point. Thank you. All right, so equilibrium, while people maximize expected utility and you have market clearing. Okay, but all this subject to incentive compatibility, of course. So arbitrage, trees cannot be priced above the replicating portfolio of arrow securities. Because if they were, the people who hold the trees could sell the trees and make money. On the other side, the trees have to be priced above 1 minus theta times their payoff. Because if they were priced below, I could arbitrage by buying the tree while purchasing them and pledging 1 minus theta to fund my purchase. Okay, but you see there is a wedge between the upper bound and the lower bound. The price cannot be above the value of the replicating portfolio, but it could be below as long as it is between this and 1 minus theta. And in equilibrium, sometimes it will be strictly below the value of the replicating portfolio, and that's what we're going to show. Okay, maybe I'm not clear. If I'm not clear, I see Adriano frowning. So if I'm
no, I was just asking myself. I think there's a short sale constraint on trees. Is that right? And does it play a role here, or just trying to connect?
Yeah. So that's another important and deep question. So the short answer is yes, there is a short sale constraint on trees and not on our securities. But in fact, this is only for simplicity, because an equilibrium, if you characterize an equilibrium assuming there's a short sale constraint on trees, well then the prices, the allocations and the consumption remain of that equilibrium. They also are an equilibrium in an economy in which you are allowed to short sell the trees. And the reason, the intuitive reason, is that for these prices and allocations, it's never a good idea to short a tree. It's better to short the arrow securities, because the trees are priced below the arrow securities. So I prefer to short something that has a higher price and the same value. So that's the intuition. All right. So, okay, so here comes a part that is actually a very, very difficult part, but I would say almost nothing about it. There exists an equilibrium. I would have been totally unable to prove that, but my co-authors are magicians, so there's an equilibrium. Okay, now let's look at the first order conditions. If you take the first order condition with respect to consumption, it is telling you that the arrow, so now we are time t, and we're looking at consumption at time t plus 1 in state S. And so here on the left-hand side, we have the arrow price of state S at time t plus 1. Here on the right-hand side, what we have here, this one is the standard frictionless market thing. That's my intertemporal marginal rate of substitution between consumption today and consumption tomorrow in that state. And here, this additional term, this is the new thing, and this guy mu is the multiplier of the incentive constraints. So when my IC is slack, I am not constrained, the standard thing obtains, the arrow price is equal to my intertemporal marginal rate of substitution. But when my IC binds, the arrow price is strictly higher, because this mu is positive, than my intertemporal marginal rate of substitution. You know, this is what I told you before in the introduction. If I wanted to arbitrage that, I could not, because that would require selling the arrow security, the expensive part of the arbitrage. And I cannot do that precisely because I'm constrained. Right. Now let's look at the first order condition with respect to the tree holdings. How many trees do I hold? Well, that condition tells us that the price of the tree is larger than or equal. Okay, so this is the scalar product between two vectors across state. So these are my private valuations for the different states. And this is the payoff of the tree in the different states. So when I hold the asset, two are equal. And when I don't hold the asset, that means my private valuation is lower than the price. This QIT is my private valuation operator. In a frictionless complete market, everybody has the same private valuation operator. But in our setting, because of the limited commitment incentive constraint, these QIs differ from one agent to another. And so my private valuation operator can be nicely written down as an average, a convex combination of the arrow price and my own intertemporal marginal rate of substitution. Okay. And so when I'm going to say more.
So Bruno, that's just the Euler equation
Yes.
that you have recursively written?
Yes, absolutely. This is how it exactly, yes. These are the first order conditions of the Euler equation.
Bruno,
we're looking at a dynamic problem and taking the first order conditions. Yes. Zach.
Just a heads up, you have 15 minutes left.
Okay. All right. Sorry. So I have my private valuation operator, my QI, and you guys, the other guys, you have your own private valuation operator, your QJ. So X is a dividend, is a vector of dividends in the different states. And so XIT, which is the set of payoffs for which I am the best holder, these are these vectors of payoffs for which my private valuation is larger than or equal to the private valuation of the others. So I'm going to hold the assets in that set. And now, because we have different QI, we have different private valuation operators. We're going to have different optimal payoff sets. And therefore, there will be segmentation. So in fact, because they are defined by these, these linear inequalities, define the payoff sets. And geometrically, that means that the optimal payoff set of one agent is a cone. So here, you have a world in which you have two states at time t plus 1, state 1, state 2. That's the payoff of the asset in state 1, the payoff in state 2. A point in that quadrant is an asset. So each point is an asset. And this cone here, this is my optimal payoff. That's the set of assets which I hold. And this is the same graph with 3 dimensions. And in fact, we can have, n many dimensions. All right. So let's build some intuition about these cones. What does that mean that it's a cone? Well, it means that, here we have the cone, and let's take an asset that is in the cone. Well, any asset that sits on the ray that comes from the origin and goes through this asset, all this line, all these guys are also going to be in the cone. And that's implied by the fact that we have defined the optimal payoff set with those linear inequalities. So basically, a cone is a set of rays. Plus, our cones are convex. If you have 2 points in a cone, all the assets between them are in the cone. So here is maybe the most important result here for our analysis of segmentation. in equilibrium, the optimal payoff sets of different agents will either be completely identical or disjoint. And in general, when we're not in the first best, they would be the same. But when we're not in the first best, people will have different codes. And so they will hold different assets. And that's segmentation. And that's directly implied just by these linear inequalities defining the optimal payoff sets. So that's an example. It's not me, I'm not able to produce that kind of beautiful figure. So with 3 states, 9 agents, 9 types of agents, log utility, almost no trees, because in general, it's very difficult to characterize explicit equilibrium. If you assume there are almost no trees, then the internal marginal rate of substitutions are given by the endowments, and therefore you can compute now things. So this is, some guys are holding these assets, some guys are holding these assets. With two states now, we can have a little picture that tells us, so this is the bad state of the world. This is the payoff of the asset in the bad state of the world. This is the payoff of the asset in the good state of the world. So assets which are here, they pay a lot in the bad state, but very little in the good state. Assets which are here, they pay a lot in the good state and very little in the bad state. And so what happens in equilibrium is that the agents who have high exposure to the bad state, in the sense that their labor income is low in the bad state, well, those people will hold the assets that pay in those states. Okay, I'm trying to give some intuition for the segmentation. And that's another way to answer Adriano's important question before. Qualitative results would be upheld if we didn't have the endowment shocks, but heterogeneity in labor endowment shocks can give rise to effects which we think are, make some economic sense, like the one I'm just describing. Asset pricing.
I'm being slow, but I didn't quite understand. So what is the intuition for why the sets are generically either identical or generically disjoint?
Yeah.
I missed the economics of that.
Yeah. Well, I'm not gonna. For the moment, I'm not gonna give you the economics. I'm just gonna give you the little algebra. It's because they are defined by these inequalities. So these inequalities, they are, in fact, in math, they are the definition of a cone. And if you have it, and they imply that if you have the same cone, or if they imply that if your cone and mine had an intersection, a non-empty intersection, it would imply your private valuation operator and mine would be the same. So it's not great economics here. You want me to try more, or?
No, given the time, just we can discuss after.
Yes, thank you very much. All right, asset pricing. So the price of the asset is held by the guy who values it the most, and therefore the price of the asset is equal to the valuation of the guy who values it the most, which is the maximum across agents of the private valuation operator of the dividends. And you can rewrite that because we said that the private valuation operators are an average of the arrow price and the intertemporal marginal rate of substitution. This is the price. So you see, theta is the extent to which we have a friction in the market. And when theta is high, we put a lot of weight on this. While when theta is 0, we're back to the perfect market case. So that implies, that equation here implies that if for each agent, there is at least one state in which this agent is incentive constrained, that implies that the price is strictly lower than the value of the replicating portfolio of arrow securities valued at their arrow prices. And as I said before, this looks like an arbitrage, but you cannot arbitrage it, because to arbitrage it, you would have to sell arrow securities, which you can't do because you're incentive constrained. So I was trying to hurry. is it time for me to conclude? Okay, I'm going to conclude. And
Can I ask a question
please,
on
please,
the basis implication? So would you like us to interpret the replicating portfolio as a derivative contract?
Yes.
And if so, it's implying that derivative assets are always more expensive than the underlying assets. Is that right?
Yes. Yes.
And if so, usually we see in the data both ways, where either we see both, for example, in CDS bond bases, both positive as well as negative bases in the data. So would you, could you comment on, should we interpret this as derivative or? Yeah.
So obviously, you know more than I do about these things. So what we say is that a tree underlying asset is priced below the portfolio of arrow securities. So, or if you want, it's priced below any portfolio of long positions in assets or derivatives. So, and the word long position is very important here. If you told me, okay, this underlying asset has the same payoff as this portfolio, in this portfolio we have some long call and short puts and stuff like that, then our model doesn't say anything. It must be that in the replicating portfolio, you only have long positions. Now, I don't know if the literature has shown a negative basis for such situations. Obviously, you know more than I do, so I should listen to you rather than talk foolishly.
Bruno, can I ask a question about the key result that the cones do not intersect? Yes. Does that depend on the types of trees in the economy? Say, suppose there's only one type of tree. How do you, yeah.
Okay, no, if there is only one type of tree, either you and I will own the tree in different fractions, or maybe you will own entirely the tree and I will hold nothing of it, or I will own entirely the tree and you will own nothing of it. The three are possible.
But in that case, the cones are going to overlap, or
no? They never overlap. Either your cone and mine are the same.
I see.
Or we don't. You know, if there's only one tree, either the cone is the entire quadrant, and you and me, we all have that, or you have that and I have nothing, or I have that and you have nothing.
Bruno, one way to interpret that is, in the one asset case, is I want to go short and you want to go long, but there just isn't enough collateral. That's the way we would think from Adriano and my work. We would say there's not enough collateral for me to be able to go short in some sense.
You're muted, Bruno.
Bruno, you're muted.
Sorry, I was saying, Vish, that you're absolutely right, and it's a very important point you're making, and I'm trying to both unmute myself and show a slide. So, in fact, in our model, for certain parameter values, you could implement the first best, and we have a result that says what for certain values, you cannot implement the first best. And exactly like what you just said, situations in which you cannot implement the first best are situations in which there is not enough of collateral. So I think that's really what you said. I think that's in line with what you said. And Vish, maybe this is a result which is in one of your papers, and I should be more careful in quoting it. I'm willing to take hints if I'm ignorant.
Bruno, can I ask a clarifying question?
Sure.
Could you contrast a bit more like the outcomes of your model with those that would come out of models with exogenous incompleteness or exogenous short sales constraints. And in particular, I'm trying to think if your model can provide guidance on which of these exogenous incomplete models are better than others.
So let me go to the literature if I can. Yes. So if you want, for example, if you compare our stuff to Garlianu and Peterson, in Garlianu, I like that paper. It's a great paper. Let's be clear on that. In their paper, everything is driven by exogenous assumptions on margin constraints for different types of assets. What we have is, we say, okay, for simplicity, let the theta be the same for all the assets. But then we get some different bases for the different assets. And our model is telling us how the payoff structure of the assets across the different states of the world will impact its basis. Another way to say the same thing is we are able to say things about the cross-section of basis or the cross-section of expected returns. And things that are not obvious a priori, which are driven by the logic of the model.
And are there exogenous incomplete markets that would generate those results or not?
Well, you can always generate what you want if you put enough exogenous assumptions. Huh?
Well, they exist out there. I think just because I think the guide, I'm trying to think of whether your model can think about giving guidance on which exogenous incomplete model is better. That's where I'm coming from.
But see, I don't agree with you.
You're that the guidance is don't use those models and make things endogenous like in this project.
Thank you, Randy. I agree with you. Yeah. But yes, go ahead, Ariane.
No, keep going.
No, I was going to say, I mean, as Georgia mentioned earlier, there are limitations to what we do. I am a fanatic of complete contracts and endogenous and everything, but okay, I acknowledge that there are limitations to what we do, even in that direction.
So let me jump in here quickly. So I think it's probably a nice time to end the formal talk since we're already into some discussion. Just a reminder, we'll open it up for open discussion now. Thank you very much, Bruno. That was a great talk. If you're in the audience, you're an attendee, if you want to ask a question live, we already have some questions on the Q&A. We can unmute you. If you want to ask a question live, just use the raised hand feature. And I think a nice place to start, it looked like Mayar asked a question. So Mayar, I'm going to unmute you if you want to ask your question live. Okay, Mayar, you should be unmuted now.
Yeah, sure. Thank you so much for the paper. It was very interesting. So my question was generally asking about the existence. I might have missed this, but I was wondering if you guys focus on no trade equilibrium to show existence, like Constantinidis and Duffy, people just consume endowments, or I mean, Pierre already answered me that's basically not necessary, but I just wanted to just hear a little bit more about the existence.
You're an existentialist. So existence. So okay. The nice and more direct way to get existence is to say, okay, the equilibrium is an optimum, and let's prove there exists an optimum, and therefore we get existence. We cannot do that because equilibrium is not an optimum here. It's not a second best because of the constraints, and in particular because of the fact that the prices show up in the incentive constraint. So that complicates the analysis. We cannot do a Negishi approach. So what we had to do, and when I say we, it's not me, it's my co-authors, is to take a much more difficult route, which is to go back to something that is like the Arrow and Debrew approach to prove existence, with a back and forth between prices and demand until we get equilibrium, with something called the price player. And that's what is used to prove existence. Maybe Pierre-Olivier, you want to add something? You're so much more competent than me, so silly that I talk.
No, so we wanted just to establish existence without relying on special case as the one you mentioned. So we went back to I mean the standard proofs and had to adapt it in two ways. One, there were issue of lower ME continuities that became more complicated because we have prices in two constraints. That it goes back to Vish's question at the beginning. We do have prices in the incentive constraint because not in the last period, but in all the period before. And I guess the other way we had to a bit work on that standard proof is because the set of trees, that goes back to what Bruno did when he showed payoff sets, is infinite dimensional. So, or anyway, the choices, the choice set for trees is infinite dimensional because agents choose measure, their portfolio are represented by measure over any dividend stream. So anyway, we had to adapt that price player proof to handle those technical issues. But otherwise, the steps are very much the standard one that are taught in first year, or at least Felix Schuler taught me in the first year. A while back.
Thank you.
We can go to Sneel Banerjee. Sneel, you're allowed to unmute yourself now. You ask your question.
Hi, Bruno. Thanks for a great talk. I had maybe a conceptual question, which is that if I think of this theta as being kind of a limit on how much I can short the asset, is there a corresponding quantity in the model that I can think of as like the price of shorting the asset? So like if I think of like, you know, in general, there's either like a repo or a rebate rate, which kind of equilibrates the sort of short side of the market with the long side. Is there some like quantity in terms of the prices of the trees and the Arbitrage securities that I can think of as serving the same role here?
So okay, maybe I'm going to say something stupid. My intuition would be, my gut feeling would be, let's look at the shadow price of the incentive compatibility constraint.
Mm-hmm.
You know, this mu, which is, you know, the multiplier, if you want, of the incentive compatibility constraint. That really tells us how much value I would get if I was able to relax my constraint. So maybe that's the price of the short sales, but maybe that's not the answer that your question required.
No, I think that I was thinking that there's probably something like that. And so if there was a way, I guess, if there is a way to derive predictions along those lines, because you know you can think of like when certain assets become more costly to short versus less, that should have predictions on sort of the cash or the market prices of these assets. And so
okay, that's very interesting. I think a translation in the current version of the model of that, I think, is the basis.
Okay.
You know, an asset will have a larger basis, you know, larger discounts relative to the replicating portfolio when it is more difficult to replicate, when it pays in states in which the incentive compatibility constraint is more binding.
Mm-hmm.
And so that's just to come back to discussion we had before. That's the sense in which, that's one sense in which by having endogenous constraints, this leads us to say something about the cross section of assets. You know, the assets which have payoffs that occur in states in which the incentive constraints are more binding, that will impact their basis.
Okay, that makes sense. Thanks a lot.
Thanks, yeah, it's nice to hear you, although not seeing you.
Yeah, I'm not sure why I can't turn on my camera, but I'm waving hi.
Can I ask another question, Bruno, on the concave? You had the prices or returns, I guess, either way. Concave in factor loadings. And your statement seemed to suggest strict concavity, but I was wondering, are the prices not linear, locally linear within the cone, so that it would be piecewise linear? I know back Fisher-Black had piecewise linearity. So I was just trying to understand that a little better.
Okay, so you know, there is a sense in which pricing is not linear. Let me try to show you. I don't know if this is going to be the right answer, but let me try. Yes. So here we have, there is a sense in which things are not linear because we have this max operator. So that generates convexity.
Yeah, I see that, but globally, for sure, I guess my question is whether locally within the cone, isn't there linear pricing within the cone so that I could take a convex combination of two assets that have different loadings and they would be linearly priced, so that they would be a global concavity, but globally weak concavity, and then strict concavity across, I guess.
Yes,
that's
you're
my
right.
question.
Yes, absolutely. I think you're right, and that's a great point. Yes. Within a cone, we have the same pricing operator, so all the assets are absolutely, yeah.
Could I ask one more question?
Yes, I'm writing down what you just said. Yes, absolutely. This is a really good point. Thanks.
Could I try one more time? So I'd like to ask a question related to Bachamek's question about what we see in the data. So in the model, you assume that all trees are in positive net supply. Is that right?
No. You could have dots in the quadrant for which there would be zero supply.
So zero or positive net supply.
Right. That's right. Yes.
If you relax that assumption, then wouldn't you get a more general result about the relation between the price of a replicating portfolio and the price of a security?
I'm not sure. You would like us to have trees in negative supply?
Some trees.
But what would that mean?
So, in the beginning, in the beginning of the talk, you highlighted the distinction between the imperfect legibility of trees versus fruit.
Yes.
And so that's another question that I wanted to ask. Could you highlight these two classes of models in which fruits and trees are imperfectly legible? Which results would differ?
So if I understand well, you say we could have a different theta for the fruits and for the trees.
For example.
Right? Yeah. So that's a good question. So well, if you look at this equation, then what you would have to do, you would have to factor it out. You know, you would have this with a theta, with a tree theta, plus this with a dividend theta, and so you would still have a basis because you would still have this idea that constrained agents value things, have an intertemporal marginal rate of substitution that is lower than the error price. But I don't know if this is a good answer. Maybe it's not, sorry.
Which insights would change if you wrote down a model in which fruit but not trees were imperfectly legible?
So, okay, so I'm gonna do take a first cheap shot at that. Fundamentally, let me be honest, the results in our model would be the same in a one-period model. I mean, the fundamental insights from the model, the take-home message the concavity, the basis, the limits to arbitrage. All of this you can get in a one-period model. And so in that one-period model, just like what Vish said before, you basically have the same equations, except that on the right-hand side, you don't have the price, you just have the dividend. So in that sense, it's really the non-pledgeability of the dividend that is really key, really necessary to get the results.
Mm-hmm. Thank you.
I have another comment. Can I just jump in here, or do I have to get into a queue? I've already jumped in. So
but Randy, I mean, we don't see your lovely face. Where
I know.
Are you?
I want you to focus on the economics and finance here.
Okay.
So one thing I found in infinite horizon models, it actually makes a big difference whether the assets are long-lived or finite-lived. And you know, one might conjecture if you go to the infinite horizon, following up on my earlier question, you may get similar results if you keep the assets. So the trees only live with probability 1, a finite number of periods. You can still think about backward induction as a way to price the trees. The big difference in what I'm finding is it's not that the economy goes on forever. That's important too. But even when the economy goes on forever, what's interesting is whether the trees are infinite lived or finite. That would be worth thinking of. You can't do that in your finite horizon economy, but in future work, you might want to take that into account.
Yeah, this is a really good point. Yes, indeed, because I think also that having the trees be finite lived would, no, I don't know. I was going to say something about bubbles, but no, I may be wrong. But
no, you're right. What you were going to say is the finite lived assets can kill off bubbles even in infinite horizon economies. That's true.
Okay, that's
it's going to depend on details, but in some cases one can prove that.
Yeah. No, thank you. That's very interesting. Yes, we should try that. Maybe Pierre-Olivier, do you want to say something about the reason that why we have this finite horizon, why it is necessary to solve to prove existence, basically? Yeah.
Oh, I don't know if it's necessary, but it helped us for sure because it allowed us to anyway, it was easier to obtain compactness in that case of the relevant choice sets.
Sure, of course.
And then, but yeah, so to do infinite horizon, what we need to do is go study the famous proof by Bewley. And I'm assuming that we could obtain existence. We've not done it by considering a sequence of equilibrium indexed by the horizon and let the horizon go to infinity. That would be the natural step from where we are.
I was going to suggest you follow, Belasco, Cass, Shell, and those people who do something similar in overlapping generations models. Consider the finite economy, then let cap T go to infinity. The hard part, of course, is to show what happens in the limit, but it's the only approach, I guess.
Yes, thank you, Randy. Yes, we should think more about that.
But this being said, as Bruno highlighted, at least for the implication we highlight, I mean, I don't think depend on one period, finite or infinite horizon. You're right, Randy, there might be new insights in infinite horizon, but I don't think what's in the paper truly depends on that.
Well, I think this is a really great point to formally end the seminar. Bruno, thank you so much. That was great. Thank you to all of our panelists for joining and all your questions and discussion. We'll end the recording now, but we'll leave the room open if you want to stick around